So we're going to jump right into our next speaker. We're going to have Quinn Thompson, CIO of Leer Capital, join us to talk a bit about, we just talked about kind of the macro, broad historical lens on what leads to reserve currency shifts. And Quinn is going to dive in and talk to us about what should you look at in terms of indicators right now to think about, are we in that moment? Are we entering a situation where a currency shift could occur? So join me in welcoming Quinn.
Thank you. All right, well, thanks everybody for being here, and I have a couple of tough acts to follow, so if you have any follow-up questions to my slides, just ask Romina and Mark, because I'm the markets guy who's just trying to make sense of all the complex topics. But a little background on myself before we get going. My name's Quinn Thompson, CIO and founder of Leer Capital. We're a global discretionary macro hedge fund focused across asset classes, digital assets, currencies, commodities, interest rates, fixed income, equities. Basically looking to generate positive returns in all environments. It's not long only, we'll be long short and play across different opportunities where we see a strong risk-adjusted reward. My background is accounting and finance at undergrad, and spent some time in New York, most recently at Guggenheim Partners on the fixed income and capital market side, and then 3 years before launching the fund, built out institutional lending, fixed income and credit desks in the digital asset space. So enough about me. What we're going to talk about today, and I'm going to present, is a number of topics, but talking about how imbalanced the American economy is today. So there'll be some rumblings from the talks you've heard earlier, how we got there and where we stand from a fiscal health position, which is kind of important to understand what comes next, and then ultimately what does come next. And a couple of things I want to stress before and that you'll see throughout is there's a number of things that you all are probably very familiar with and data points and facts you've heard that seem random and unconnected, but in many ways, all of these different trends pervasive throughout society, whether it's income inequality to demographic inequality and things like that, are actually all connected. Like this quote you sometimes hear, it's all one trade. They really do boil down. It's just a matter of where they fall on the second, third, or fourth, fifth order chain of events. And the other thing is just reflexivity is a thing to think about. When things are going really well, it's easy to think I'm a genius and everything we're doing is great. And then when things go poorly, it's bad luck and how could this happen? And we have just human nature, a hesitancy to kind of see the full picture at all times, and there's always two sides of each coin. So I'm going to try and explain why I think this stuff is relevant at an increasing pace and in the near term. One of the things us macro people tend to get wrong a lot is these high conviction long-term views that take 10 years to play out. But I think what we're going through and talking about is very prudent for today. So getting going. The US has benefited, we all know, from this extreme form of capitalism, basically one of the most successful economies ever built. This chart on the left here, you can see the MSCI All Country All World Index. The US comprises 26% of the index's GDP, but 65% of the equity market cap. The largest companies in the world, over here you can see US, China, Europe. One of our top 10 companies is bigger than all of China and Europe top 10 companies in total. So these numbers just seem kind of staggeringly like, how could that happen? Trust your gut. And the other thing, to put it all into context, is the US is less than 5% of the world's GDP, population. So less than 5% of the world's population, 65% of the market cap, and the Magnificent Seven dwarf anything similar across the globe. Seeing that chart visualized, so the blue lines here are US equity outperformance relative to the rest of the world. As you can see, we're at a very, what I would call peak, extreme imbalance that, if you look back in history, has happened multiple times and mean reverted multiple times. And we'll go into why this cyclicality exists, but it's important to realize where we sit. And it's always at these tops and extremes that we think this time is different, we're special, this is going to last forever. The other thing I'd point out is the orange line here. So the blue is US equity outperformance. We're outperforming the whole world. The orange line is the trade weighted dollar index. So that is the strength of the dollar relative to other fiat currencies. And what you'll notice is the extreme correlation. And the simplest way to put that is When US assets are the top performing asset class in the world, you need dollars to chase those assets. So it's sort of one and the same. US stocks are going up, US real estate's going up, and I need dollars to buy those assets, and that puts upward pressure. This is part of this reflexivity, this exorbitant dollar privilege you hear talked about that we've very much benefited from. The other thing in terms of capitalism, it's led to globalization. We've adopted a complete free trade approach in many ways more so than anywhere in the world. And that's led to a maximization of corporate profitability. So we've outsourced our manufacturing jobs as a percentage of the total workforce has been in secular decline. You can see here that's pictured in the red line and service industries growth in the blue. And so basically what's happened is we've taken the view that it's optimal to maximize for corporate profitability and aggregate outcomes, maximizing total GDP, and at the expense of things like national security or supply chain security, and in many other things as well that we'll get into. The loss of these manufacturing jobs, the rise of white collar jobs also have other ramifications. One of those costs is record inequality. Everybody knows this. It's not just a U.S. thing. It's global. But income inequality is quite obvious. We've had kind of record dispersions. That's led to wealth inequality as well, where the number of people in the middle and lower class has actually increased, while the wealth in that pool has decreased, and the rich have gotten richer. And there's a number of reasons for this, but it has to do with those jobs that comprise of the lower and middle income class leaving, wage growth not keeping pace because there's less jobs available, more competition for those jobs in those cohorts. That's suppressed inflation for those kind of base level goods and services. Lower inflation is higher asset prices, and asset price appreciation accrues to the wealthy and the white collar jobs. This also has a very strong correlation to demographics. So you hear about, the baby boomers are kind of milking the system and are in control. We know the age profiles of our sitting congressmen and senators. But this is that chart. over 30% of household wealth is held by Americans 70 plus. This is the same thing. These are, older Americans have been in the workforce longer. They're asset owners. They've benefited from this rise in U.S. Asset appreciation and the system in general for longer. Why these things start to become a problem. So the fading American dream, doesn't matter where you're from, you're born here, you're born somewhere else, your race, religion, creed. One thing that binds Americans historically is this belief of the American dream and optimism that, striving for a better future and opportunity set than what we were given. And you can see that, again, secular decline in percentage of children earning more than their parents. And presumably, you can extrapolate this forward because nothing is really stopping this train, and that's going to drop under 50% shortly, meaning a much less optimistic vision of what generations before grew up in. One of the things that leads to, and you'll see why we're getting to this extreme levels of imbalance that ultimately lay the seeds of it toppling over on itself, is the average number of people per U.S. household is continuing to shrink. And if you think about it to the extreme case, if somehow we were to prolong this series of events even longer, you're getting to a point where you're at almost under 2 average household sizes in the U.S., which basically we're already at 0 population growth without immigration. You're looking at population declines. And the other thing, if you put it all together, why we're to the point of maximum instability, is because the solution agreed upon to fix this problem is actually exacerbating the problem. And so what I mean by that is immigration policy today, very contested topic, but it's the policy of the last number of years on a relaxed border has been solely to increase population, import population growth. And what that's actually done, similar to what I mentioned about outsourcing manufacturing jobs, it's very difficult to import population growth for white-collar jobs, but easy for lower and middle-income jobs. And that immigration comes in, it suppresses wage growth for the lower and middle-income class, It also then reduces inflation, boosts asset prices, and benefits the wealthy. So the way that Congress, instead of fixing the system in total and a more comprehensive approach, is going about this is actually making problems worse. And that's one of the cues to start thinking about how this is going to come to a head. And so I call it an unstable equilibrium. Again, try to throw some memes in to make sense of things. But basically, the U.S.'s capitalism has led to an extreme outperformance and rise in maximizing for aggregate GDP at the expense of the median outcome and fairness and equality. Globalism, that inequality creates a demographic divide, who's in power, who's still controlling where the money flows, declining population growth, and at some point, your economic system and engine slows down to a point that can't sustain the music kind of stops when your population starts to decline. You can look at Japan and Europe for further along. So the next stage is, so I'm describing this picture of a very imbalanced, things need to change, unfair system, repercussions and costs that have been associated with what many of us in this room are lucky enough to take part in, which is a bustling American economy. But underpinning that is also what I would consider some unhealthy trends that Romina and Mark both have alluded to. So we've talked about ad nauseum how deficits have been institutionalized at a very unsustainable rate. And so what you'll see over here is the light blue line is the fiscal deficit, so lower, meaning bigger negative deficit. The dark blue line is the unemployment rate inverted, so lower on here means a higher unemployment rate. And so what you'll see is, historically, when the unemployment rate would go up, job losses would come, you'd stimulate, but then when you fix the problem and help the economy get out of things, the hole it was in, you normalize your deficit. And you use this as emergency stabilization means. And over time, that light blue line has just drifted lower and lower, worse and worse. And then the other thing you'll know is this jaw is widening, where what used to be deficits rising just to stabilize and reignite the economy in times of turbulence, war, and recession has now turned into increasing, worsening deficits just to keep things afloat. And again, that's kind of when you know it's starting to become a problem, when you just have to continue what you used to do as emergency measures just to keep the music playing. This chart shows those annual deficits flowing into debt to GDP. And the orange lines are the estimates from different years dating back to 2007. This is where they said the debt to GDP was going to go. And the white line is where it actually goes. And the thing to point out here is the most troubling aspect about all of this, and we talk a lot about the mandatory entitlement spending and all of these aspects, and those are bad, and those are, we need to get to a balanced budget over the long run. But there's two events in the last 20 years that account for 90% of the increase in our debt burden. The global financial crisis, so we went from about 40 to 100% debt to GDP, and the financial crisis took us about 35, and another 20 of those percentage points in COVID. So if you're thinking to yourself, okay, we're on this difficult trajectory, but what happens if something worsens in the economy, which I'm going to explain I think will happen, you're looking at the potential for even greater step function change and where some real unsustainability concerns will ignite. So why is that possible? Why can the U.S., none of us can sit here and spend for 20 years on prolonged period more than our means. We'd be in debt, bankrupt, et cetera. Why can the U.S. do that? Two big reasons. The Federal Reserve monetizing the debt balance. So you can look back to the balance sheet growth of the Federal Reserve. A big delineation here is when we run fiscal deficits, the Treasury has to issue debt to finance that spending. That is not actually money printing. But when the other side of the government that's quasi-independent, the Federal Reserve, starts to buy that debt in the open market, alleviates the responsibility of other market participants from purchasing the debt, which is liquidity negative, that is the monetization, the money printing, the memes of Jerome Powell printing money. And that's witnessed by the Fed's balance sheet growth. So they're the number one largest buyer. And the second largest buyer is foreign trade partners. This is the annual U.S. trade balance, large deficit, about $1 trillion every year we're spending, paying out for imports of goods and services to international counterparties more than they are buying from us. So basically, every year, $1 trillion of dollars go to international counterparties for their goods and services because we are the largest consumption-driven nation in the history of mankind. And that is dollars proliferated across the global economy that then is reinvested into U.S. assets, U.S. real estate, U.S. companies, U.S. stock markets. And ultimately, because of the prospects of doing future business, you need to keep those in dollars. And so the two biggest buyers are the Fed and foreign buyers. This is the dollar index relative to other fiat currencies. Sitting down and thinking through this, I should also have the dollar index relative to gold, because two things on this chart is you hear the phrase cleanest dirty shirt in the laundry basket. This is the dollar relative to other fiat. Every other fiat also has some pretty difficult problems along the same lines. But the other thing is this reflexivity. So you'll see quite the consistent, fairly over a very long period of time, rise in the dollar index value relative to the rest of the world. And that is this reflexivity where foreign investment comes in the U.S., we're buying their goods and services, they have more dollars, they buy assets, we become the largest and kind of best performing market, and it feeds on itself until there's no one left at the party. So why is this important now, and why could this reverse now? Well, number one, the Federal Reserve, who I said was the largest buyer, is not buying U.S. debt right now. They're actually reducing their amount of debt, and they are not providing liquidity in the market because inflation is too high for where they can, in normal course, support the debt market and buy the debt. So you have the largest buyer out of the market, and then the foreign buyers is the other big problem, who are also on a buyer strike. China and Japan have been reducing their holdings, the number 1 and 2, and the United Kingdom actually just passed China as the second largest buyer of U.S. debt internationally. But the thing to point out is, what do you think tariffs and cutting off immigration and travel bans and different types of protectionist and populist policies do to foreigners' appetite to feast on U.S. assets? It's not good. And so every indication is that this trend will continue. And on top of it, as I mentioned, all of these, aside from China, Japan, UK, and most other nations, have their own foreign bond market difficulties, which also limits their ability to keep prolonging this and buying U.S. debt. So you have the two largest, establish the deficits, you have increasing amounts of debt needed to be issued, and you have the two largest buyers of U.S. debt on a buyer strike. This has resulted in what was a 40-year secular decline in U.S. interest rates, the cost of our capital to finance these exorbitant budget deficits, with a meaningful trend change. So over the last post-COVID period, we've seen interest rates continue their both cyclical and secular increase. And for these reasons I mentioned, more supply coming, less demand from buyers, it's highly likely to continue and in fact exacerbate once this bill passes and there's some refunding mechanisms that need to take place and a lot of issuance coming. So this is also a big catalyst for why now? Why does it matter now? Because the music could play very cleanly and smoothly when the cost of debt was going down and the buyers, more and more buyers were coming to the market. All of those things have changed and the cost of debt is now rising. So I kind of think of the situation as like the Wile E. Coyote Roadrunner scene where he's running off the cliff and still running and thinks he's running away, but looks down and there's nothing there. Because just at this moment where our cost of capital is rising, the buyers are stepping back, everybody is fully allocated to the U.S. asset. Where in the U.S., allocations to equity markets are at all-time highs, debt and cash lows. You can see, again, the cyclicality and the concentration of 40% of our S&P 500 indices are concentrated in the largest stocks. And again, the cyclicality of any of these things over long periods of time, granted, are obvious when you zoom out. And this comes at a time when the music is starting to not be playing so loudly anymore. And that's where I come back to this reflexivity thing, where you actually kind of run into the same issues that helped propel things so highly to the upside, the outperformance, everybody's happy, I want more dollars, I want to visit the US, I want to travel here, send my kids to school here. You start to see the errors in the armor, the chinks in the armor, and it starts to roll, where asset price maybe starts to underperform. I don't need as many dollars. I get tariffed, things like this, these protectionist policies. And in almost a riskier way, when the dollar starts to go down on top of asset prices, that's a very inflationary outcome that leads to some of the things we're talking about. So to summarize it, why does this matter? You have record annual deficits, increasing the amount of treasuries you have to issue. You have exponential debt growth. The financing sources to let that absorb into the market are shrinking, creating a higher cost of capital, puts pressure on the dollar, and ultimately is an inflationary outcome. So this is, I thought, the best meme to describe that. The last thing is kind of where we're going and why this all matters. Populism, inflation, and debasement. So inequality, these are kind of all one thing and different pockets. So on the populism side, this has to do with the inequality we established at the beginning. So it's not, again, just a US thing, it's a global thing. And these are rooted in equality and optimizing for median outcomes in a world where we've really just been maximizing for total GDP. And it's becoming mainstream. These factions always existed, but they're just becoming louder. So populism exacerbates these trends. It puts it into overdrive. One of the things we all know well by now is tariffs. So we're rising to a highest rate since the 1940s on tariffs and protectionism. And this is a near-term demand hit where it's a consumption tax. It's like raising your income tax where, okay, someone's got to pay for it. There's going to be less consumption in the near term. But in the long term, you have to rejigger supply chains. You have to reshore, nearshore, friendshore, a lot of investment. It's inflationary in the long term when that demand comes back online. And it's part of this whole double-edged sword where, yes, tariffs probably are part of the solution where you need to rein in some of this kind of borderless free trade to help our lower and middle income class and bring up median outcomes. But the double-edged sword is it deters capital into the US. It's actually inflationary, so it exacerbates some of these negative side effects. So all in all of these things are nuanced where it might be good for the people, but it's really bad for market. The second point is immigration. I don't think this is getting talked about enough in terms of its market implications, and this is maybe the most interesting data point I'm proud of because I just don't hear people talking about it. So the orange line here is the spread of bachelor's degree and higher earners, wage growth, minus high school and lower. And so when this orange line is coming down all the way to mid-22, that's saying that high school and lower degrees are wages growing faster than the bachelor's and above, meaning the lower and middle income class workers' wages are growing at a faster clip than college and above. This came to an end in 2022. You'll also notice the green is inflation. So what also came to an end in mid-2022? Well, the top was inflation. And the pink line, this dates back to the immigration thing I talked about earlier, is southern border apprehensions and encounters. And I'm of the firm belief that the sole, forget like the virtue signaling and the grandstanding and everything else you might think about immigration. There's rights and there's wrongs. I'm not here to talk about that. Just numbers. The sole reason why there was an open border policy was to fight immigration, or to bring in immigration to fight inflation, because it's a very clear delineation. And that is part of the solution. Again, this is kind of the double-edged sword where you do need population growth to sustain a growing and strong and healthy economy. But it's at a cost. The cost being huge supply because they didn't reform the actual total system and bringing a mix of educated and lower middle income jobs. It put an exorbitant burden on the lower middle income people in the US because you had all of these people coming in, competition for labor, and farming, hotels, any type of thing like that. The increased competition pushed pressure on wages. So at that exact point, you see lower and middle income wages not growing nearly as much. You see the upper class wages growing again. And it has to do with inflation. So on the one hand, it's good. Inflation's lower. People are happy. Asset prices go up. But that comes at the direct expense of lower and middle income class to benefit the wealthy and high earners. And it's actually starting to come up now in the other direction, where Walmart took out a huge full paid ad in newspapers. All the hotels, all the construction, home building companies, they're very, very scared about this problem because their corporate profits are getting hit, because they are going to have to pay people living wages to fill these cleaning jobs, these construction jobs, these manufacturing jobs, where before they were getting extremely cheap labor that helped their corporate profitability. It was disinflationary, but it was bad for those people, and it was good for asset prices. So that's also reversing. So two huge trends. And let me just show the magnitude of this. The blue this is our total employed workers in the US. The blue is native born. Makes sense, this is the US. 80%, 20% is foreign born. And over time, we're a melting pot. You'd expect that to grow, and it has grown. It should grow. We have immigration. But the native born total employed is 4 times the size of foreign. But in the 2 years where our inflation dropped the most, post-COVID, foreign-born jobs vastly outnumbered on a magnitude of 2x the native-born. So that exemplifies exactly how huge immigration through the southern border was. And this is just the government documented. You can imagine how many cash-paid farming and all these other labor jobs. And it's reversing in a big way in 25. Putting all that together, and why I think it's sort of coming to a head, is the backdrop of the weakening consumer that's persisting today. So you're seeing credit card and auto loan delinquencies rising. Student loan delinquencies spiked up when the end of this defaulted loan forbearance program ended. And actually, a similar program for mortgages is happening in the fall. So in September, the FHA delinquent forbearance program is ending, and we expect a similar, although less massive rise in the yellow line, which is going to present really big headwinds for the economy. This comes at a time where the housing market is already slowing. This is inventories of new homes is back to 2006, 2007 levels. So this is a big narrative violation, because everybody tells you that there's a huge housing shortage in America. If that was the case, then why is the supply of new home inventories rising back to 2006, 2007 levels? And the reason is lack of affordability for 3 reasons. Prices are too high, financing costs are too high because our cost of capital is going up, because as Romina mentioned, we're crowding out the private spending, and no one can afford it. And so that's why supply is stacking up. This lack of affordability can be seen normally the orange line, new divided by existing price premium. So normally a new house costs about 15% right over here more than an existing home. It's new appliances, it's newly built. But in these times of extreme excesses and peaks in housing market, you see this premium. Basically, there's such a glut of new homes, they can't get them off the market quick enough, so they have to start knocking the premium all the way down to 1, where the new and existing homes are trading at the same price. And the last time this happened was 2006, 2007. And think about what also happens to the supply of inventories of new homes when you have a mass immigration halt and deportations. So we're of the expectation that the housing market is going to start more meaningfully cracking and becoming a very big headwind to the growth of the economy. So to sum it up, you have this unfettered capitalism, globalism, extreme outperformance and magnificence of the US economy, stock market, and asset performance. That's led to an extreme wealth inequality and demographic divide that's extremely unsustainable, and the conditions being set to topple on itself. Meanwhile, the US government's fiscal position and debt and deficits have propelled so much just to sustain this kind of faulty system to the point, and with large factors trend reversing. And then you mix on top of that some populism, some protectionist trends to kind of add fuel to the fire. And we're of the belief that there is a crisis brewing in the next 12 to 18 months. The economy is slowing. There's the avenues to kick the can are diminishing at a quicker and quicker rate, and ultimately what happens as a result of all this typically ends in some sort of crisis, or whether it's real or manufactured, where then one of 2 paths can be chosen. And so the other point I wanted to stress is this next recession is not going to look like the ones in recent memory. And there's a typo up here. I told you I can't do math. That should say -1. But austerity and balanced budget is one way. You can fiscal responsibility, less government spending. But what that does is result in nominally worse outcomes. I lose my job. I take a 10% pay cut. You're getting disinflation and deflation. Your house is worth less. All the numbers on the page are lower. That's a nominally worse outcome. Or the tried and true method, what we will end up doing is financial repression, where we stimulate monetarily and fiscally and get a ton of inflation, where you can have the same real GDP purchasing power outcome. If you have 0% nominal growth and 1% inflation, that's -1% real. Again, this should say -1% real, but that's 3% nominal GDP growth and 4% inflation growth. That is a hugely different type of recession and what happens during that. But that is the route that we'll also take, and that's why you're seeing increased demand for store of value assets, gold, Bitcoin, because in the financial repression version, I still see my wages growing 3% per year. I still see my housing price going up, my asset prices going up. This is amazing. But in a real purchasing power basis, that inflation is the invisible tax, and that's the financial repression. Just to sum it up, we've seen a very good example of this. I think what we're going to experience is a slow-moving COVID. The blueprint has been laid. Oddly enough, there's a same China geopolitical rivalry undertone. There's supply chain disruption, lockdowns versus tariffs, pandemic versus trade war, huge hit to business and consumer confidence. It creates a short-term demand shock with long-term supply issues. The resulting effects is government stimulus, both monetary and fiscally, under the guise of it's an emergency, we got to do it, with the net result being secular inflation. And a couple other examples, things to watch for going forward. Most of you probably don't know, but in March 2023, when we had this banking crisis, the government enacted both QE in a more stealthy way via a BTFP facility that allowed banks to finance against their assets differently, and fiscal stimulus via backing all FDIC deposits. October 23, there's similar events via covert yield control where they basically manipulate the treasury debt issuance to make it more shorter term versus longer term to help suppress long-term interest rates, and then draining different liquidity facilities at the Federal Reserve that pump more liquidity in the system. So there's just all these mechanics behind the scenes that they can always kind of do to kick the can. The ones coming up to look out for are the statutory leverage ratio, where basically they want to make it legal, help banks buy more treasuries to, as I mentioned, the buyer strike from the Fed and foreign buyers. So they need banks here domestically to buy more. They're also debating removing interest on bank deposits held at the Fed, which increases the total base of dollars where they can apply the inflation tax to. And it's our view that sometime in 2026, they will resume blatant asset purchases and quantitative easing as a result of some sort of crisis, response mechanism alongside more fiscal policy. So that wraps it up. Hopefully pieced a couple things together, and thanks for listening.
Excellent. Thank you, Quinn. And we do have a little bit of time for a little bit of Q&A. Our predictions for how the debt's going to grow, they don't take into account any possible step changes that might occur, even though those have happened in the past?
Yeah, and as Romina pointed out too, they vastly underestimate the financing costs of
Thank you.
what the interest rates are likely to be. So that's why year over year we continue to, we're predicting a 5% deficit from the CBO, and it turns out to be 6.5. And now we're predicting 6, and let's see, it's probably going to be 7.5. And those step function changes from the crises are because it's such an emergency and such a crisis is when you get even the bigger ones.
Are there, and those are the predictions by the Congressional Budget Office?
Yeah.
Or are there third-party, independent academic institutions that make projections that take into account potential step changes? Or is it just like, those are always unpredictable events, and so we basically never forecast them?
I think it's more like that. I mean, you definitely could apply some framework to smooth that out over time. And And the answer isn't pretty. If you think of a 40 to 60% debt to GDP burden increase over 20 years, by 2040 or whatever, you're looking at closer to 200, 160. Yeah. So it's and the other problem is they get bigger every time. So what started in the GFC is a $2 trillion balance sheet increase for the Fed was then a $4 trillion in COVID, and the numbers just kind of get bigger.
It's daunting. Okay, so for crypto people in the audience, we're very familiar with bubbles and the sort of blow off top situation. We've been trained on this 4-year clock with Bitcoin and all the other crypto assets. That was a remarkable framing for me to make sense of the current American asset situation. It seems like we've been in a sort of bull market for so much longer than crypto people would be used to, right? We're used to this sort of speculative 4-year cycle of people get excited and then and then it's too much and people leave and so on. How is it possible to be in that condition for so long? Rather, why hasn't it already fallen apart just based on people being like, these numbers seem kind of crazy, we should start selling? And then related to that, would you say, is it the case that these US corporations are massively overvalued from just like a discounted future cash flow perspective? Or are their valuations sort of reasonable from a value investing standpoint, but you have all the stimulus and underlying things that are prompting all of the cash flows and economic party that maybe would fall apart underlyingly?
I think it's twofold. So why, you look at that chart and you're like, this is so obvious, like this is going to mean revert. But the thing is that chart is 70 years. And one of the things everybody's aware of in our new financial system and economy today is the financialization of everything, short-termism. You used to have corporates reporting their financials every year, then it became 6 months, now it's quarterly, and now half the companies do intra-quarter updates, monthly updates. And so the investment horizon of the average investor has shrunk to monthly and sometimes even lower. And another point of that is the driving force of volumes in the equity markets are from high-frequency market makers, the Citadels, the Millenniums, the pod shops, who are doing just extreme arbitrage on very short and often non-fundamental bases. So I think that the short-termism and some of these other passive flow dynamics is what contributes that, because it's such a hard trend to bet against. And things can stay elevated longer. And then on the second piece was, the second question was?
Yeah, basically, do you think that just in terms of PE ratio,
the valuation,
sane or not?
They're historically at all-time highs, so it's not. No, they're not.
It's like everything is a meme stock at this point.
Yes, when liquidity is the sole driver of everything, it creates very unpredictable outcomes and things that can sustain much longer. But then when kind of liquidity removes and rationalization is forced back into the market, they look egregious. I mean, we're at all-time highs, and we've just kind of been here from a valuation perspective. Granted, there is, if you look back at 3 years, 4 years, it's reasonable to that's how everybody projects is, okay, they grow 10%, 50% every year for the last 3 years, they're going to do that. And so that short-termism in the market and investing world has reduced the number of people who kind of actually take longer-term views. Yeah. Warren Buffett's been building a cash balance for 3 years to his highest ever. And I think he might be the only one left taking multi-year approaches. And those valuation at all-time highs will matter. And again, that reflexivity, where the point where valuations come down, cost of capital goes up, growth slows down, profits get hit, your earnings quality reduces, inflation is higher. It's this like super reflexive cycle that makes things amazing up here. But
you sort of get an interesting lens on the world when you watch crypto markets for long enough, because you realize that valuations don't have to make any sense, at least in that environment.
Right.
And that's one of the lessons I had to learn early on doing business in the crypto world and thinking about our own runway and so on, is just, when you're trying to understand the crypto markets, you sort of have to forget about all the normal valuation stuff. And so I wonder, are we in the same kind of situation where, the world has capital, it wants to invest in something, And is it the cleanest dirty shirt phenomenon? Like if there is a massive sell-off in U.S. equities and U.S. Basically the treasuries, where's it going to go? What are people most likely to buy instead? Is there just a problem of people not having confidence in anything else, or do you feel like you have a projection for where it's almost certainly going to have to go?
So even up until this most recent sell-off in April and the bounce back, one of the phenomena is across the investing universe and market participant landscape, gross total leverage ratios actually didn't decrease. So we had this huge sell-off. But what happens was if there's a bunch of investors that are long assets and short assets, and the longs minus the shorts equals the net came way down because people panicked, sold. But how the net came down was by increasing shorts. So gross leverage actually went up. And one of the byproducts of this extreme liquidity being pumped and facilitated through the system that we're talking about is obviously inflation and so on. But it's more hot air into the machine. What ultimately solves this over time is taking the hot air out, which is a deleveraging, a basically degrossing event in the markets where everything gets hit because nominal wealths are, I guess, too high to be sustained without that constant influx of liquidity. So it's a constant debate that value and growth investors have where you can be a very successful investor over 5 to 10 year horizons simply because this environment exists. But if we do move into this different environment, which we think the kind of tectonic shifts are pointing towards, then valuations do matter because you have to buy something based on what someone else will pay for it in a rational world, not a liquidity boom world. And you see deleveraging and degrossing across the board. There's not really many assets that are safe in that. Cash and inflation protected securities, maybe gold, but gold even gets hit in deleveraging. Bitcoin gets hit in deleveragings, and maybe treasuries could show a slight bid, but it's also a difficult place to be with the pending supply both now and what comes after the deleveraging. It's a tough time. I mean,
yeah. Okay, I have one last question for you. I was looking up last night who holds U.S. Treasuries, just the split between domestic ownership and ownership abroad. And I think it's 2/3 owned domestically and 1/3 owned abroad, which actually, if you think about it, we talk about U.S. dollar being the world reserve currency and so many other nations and people holding our debt relative to the U.S., but 1/3 didn't strike me as that high an amount. It's like if you looked that up and you found out it was 2/3 or 3/4 held abroad, I wouldn't have been shocked by that. So I was a little surprised that that's actually not very high if you just think about it in world reserve currency terms. But with that in mind, I guess my question for you is like, which foreign buyers, you talked, I think, in this presentation about foreign buyers leaving and holding fewer US assets. Can you say again which ones are leaving? But I'm also curious to know, how do we know that? How do we keep track of who's holding these assets? And where do you look on a daily or weekly or monthly basis to update your understanding of which foreign parties are holding these US assets?
Yeah, so when the Treasury does auctions on a weekly basis for different tenors of their maturities, they publish the composition of the buyers, foreign and domestic, and over longer periods of times they publish, I think it's a monthly basis, this data of where the buyers are. The point on domestic, international being 1/3 is a good point. And I would just compare it to that slide where US is 2/3 of the world's market cap. And so that kind of aligns if you think about it where, because in a lot of these cases, so 1/3 of the world's market cap is non-US. And so it kind of makes sense with those numbers. But in a lot of these cases, they own more, our bond market is so much larger than these other countries. They own comparable amounts or more of our debt than they do of their own. The Treasury website, a lot of this is like FRED and government data sources that you can see, like all that immigration data is public. And so it can be tracked fairly regularly, weekly, to see kind of how that burden's shifting. And it should get more interesting too with just the increased tariff protectionist and
Yep.
and geopolitical stuff.
Makes sense, makes sense. And I was going to ask you whether you thought we were going to monetize, but you already told us what you believe there, so I appreciate that prediction. Thank you, Quinn, for joining us.
Yeah, thank you.